Turn up and get the next panel underway. And the next panel is all things brewery finance, a very important topic, as I'm sure you'll all be aware. And I'll let Callum Reeves from Kaiju introduce the panel and get things underway. Thank you, Callum.
Thanks, Matt, and welcome everyone. As Matt said, I'm Callum Reeves. A bit of my background: I co-founded Southeast Brewing Company with my brother Nat in 2012. We make probably somewhere between 1 million and 1.5 million litres, I guess depending on the inflation at the time and interest rates. And we're still 100% family owned. We've grown our business through family and bank loans. We did have a government grant of a couple $100,000 a couple of years ago. I'm also on the board of the IBA. So it's my great pleasure to introduce the panel that we have today, starting with Dave Padden down the end. Dave founded Akasha Brewing Co. in 2015 to bring hop-forward beers to the people of Sydney and Australia. Akasha has drawn on multiple sources of funding over the years to grow the brewery, as well as hospitality venues in Sydney and Newcastle. Next, we have Liz Zella. Liz is the National Manager for Go-to-Market and Projects at Shift, a company that provides finance and technology solutions to simplify business transactions. Liz works with businesses across hospitality, retail, and loads more to take the hassle and risk out of business transactions. And Damien is a director at Midland Insurance Brokers, where he has been for over 20 of his 25 years in the insurance industry. Midland are specialists in insuring breweries and distilleries, as well as much of my expansive property portfolio, and currently insure over 120 breweries all over Australia. Disappointingly, he is unable to insure the motorised esky I won from him at BrewCon a few years ago. Damien, I'll start with you. As an expert in brewery insurance, do you have any advice for us about insurance, and more specifically about the types of insurance that are most important from a financing perspective?
Yes, definitely. Thank you, Callum. I know insurance isn't the most exciting topic for you guys, so I'll try and keep it as quick as possible. Generally, we find that the finance companies won't settle the finance unless you've got insurance in place. So if you're a startup, and you're going to be doing a fit out, you would generally need what's called contract works insurance or construction insurance, like what builders have, and that covers you while you're doing your fit out. Once that's finished, you then go for your business insurance, like a business pack as a small business for an SME, and the finance companies will need what we call property insurance, which is the cover for the buildings, the contents and stock. They probably won't worry about the stock, but the contents is the main thing. If you own the building that you're in as well, they'll obviously want to have the building insured. So they're probably the two main ones for the finance side of it. But as a brewery, you also need to have a few minimum covers in place, apart from the property cover, but business interruption, which is loss of profits or income if you have a big loss, such as a fire, massive storm that shuts your business down for a period of time. So this will keep the money coming in while you re-establish the place. Burglary. So the burglary also needs to cover the excise. So if your stock is stolen and it leaves your premises, you're still liable for the excise. So the burglary needs to cover that as well. Excuse me. And probably the most other important one is the liability. So your public liability, which is things like slip and fall claims at your premises. So we're actually starting to see a trend in slip and fall claims happening at breweries. Not necessarily from people being drunk, but just we had a couple where people just walked in and it was raining outside, slipped on the concrete, and they sued the brewery because it's someone else's fault. Product liability is the other one. If something goes wrong with the beer, somebody drinks it, they get sick or die, you get sued. So they're the most important covers that you need. A couple of others, like you can have money cover, so if you've got a lot of cash going through the business, you can cover the money. What else you got? Machinery breakdown is another one that some people take out, covers an unforeseen breakdown of your equipment, pumps, things like that. What's a couple of other good ones? Glass. So windows, so a lot of leases will make you take out the glass cover. the landlord will make you take that out. So you generally have to have that as well. A couple of other important ones. If you've got a lot of stock that's being moved around, so doing deliveries and things like that, transit insurance, not a bad idea to have that. So that covers it if it gets stolen or damaged whilst in transit. And if you're also using 3PLs, they generally won't insure the stock for you, so you need to take it out in case they cause damage or loss to your stock. Motor vehicle insurance, if you've got vans doing deliveries and cars for the sales team, so you need to insure the cars as well. A couple of other ones to think about that not many take out, but it's worthwhile if you can afford it in your budgets, if you're doing a lot of travel for work, so corporate travel covers you while you're moving around Australia and overseas. Cyber insurance, you probably hear about that a little bit more these days when there's a big cyber hacks like Medibank and a few things like that. Covers the costs of fixing your, getting your servers up and running again, but also the privacy breaches that happen as part of that as well can be very expensive. So something to think about. Product recall. Not many people take out product recall. It is a bit expensive, but it's expensive if you have a recall. You think about how much it costs you to get off every shelf, especially if you're in the big retailers around Australia. It costs you a fair bit. Management liability, which for those that are doing crowdfunding is probably becoming a bit more important as well because you're responsible to shareholders. You're almost like a public company. So there's some what we call directors and officers cover in there, so it's something to have a think about as well. And probably the last one is trade credit insurance. So if you've got big exposures to customers providing credit to customers, and if they go under, that could really affect you and your cash flow, then that's something to have a think about as well. But they're probably the main sort of insurances that you need to think about as part of running your business.
Yeah, I mean, I don't think it's fair to characterise insurance as unexciting. I've never had quite such a rush as when Damien's told me, yes, you are covered for that. Liz, so from your perspective, how can brewers best use finance to improve business processes?
Yes, well, it's been really interesting when we have a look at especially like the last 12 to 18 months. You would have seen within your own businesses, your costs are increasing, interest rates are rising, trade debtor days are blowing out. Even in the last 12 months, we've seen those debtor days blow out by an average of 12 to 14 days. We're seeing supplier invoices, about 47% of them on average are unpaid. It's becoming a real problem for a lot of businesses, that cash flow and managing the cash flow. What we've seen businesses do in this last 12 months is really start to look at where they're focusing their efforts, looking at different ways that they can manage their cash flow and keep their focus on their core business activity. So with Shift, we do offer a platform to manage trade accounts. Very different from your traditional trade accounts that you're probably doing within your own business, where you might bring on a new customer, they want trade terms, you're not real sure about them, you don't know them too well. It might start off on cash on delivery. Once you get to know them, you might start giving them terms, but you're wearing that liability, you're taking that risk. Through our platforms, we'll vet that customer, we'll take on the risk, we'll give them a facility. Typically, we'll be able to give them facilities higher than what you're probably willing to give them on a trade account, which means they're coming back to you and they're buying more stock from you. And then we'll worry about chasing up that money. So you can still give your customers trade terms, but you're removed from that risk. Technology is amazing in what we can do in the finance space. You're probably very familiar with consumer finance and how quick and fast it is now to get access to mortgages, get access to buy now, pay later. It's all really quick and fast for customers. We're bringing that into the business world. So you're moving away from all those traditional paper-based trade accounts. Our digital platform allows us to onboard those customers in minutes. It's about a 5-minute registration process. You can be issuing invoices to your customers same day and getting the comfort that you're getting paid up front. And your customers still getting that flexibility for trade terms.
Right, thanks, Liz. Dave, you've had a really inspiring journey, and one that I've certainly respected and loved to watch over the last 8 years at Akasha. It'd be great to hear a bit about that experience and any advice that you can give on the pros and cons of the different funding models that you've used.
It's a rather large question,
isn't it?
Yes.
We've got some time to fill, I think.
Excellent. Yeah.
Actually,
I'll try not to take too much of it. Look, we've been through different models of funding along the way, and I think and there's probably three main ones that I'll outline, and each of those really will work for us. I'll give you what I think anyway, which is take it with a grain of salt, but at each stage, that particular type of funding was appropriate at the time. So when we started the brewery, for instance, it was very difficult for us to get bank finance because we didn't have a track record. At that stage, we didn't have any assets, and the only way for us to do that was to mortgage everything we had personally. So it wasn't something that we really wanted to do. So what we'll say, and I'm sure many of you guys have done the same thing, we have effectively private investment, so from founders of the business or family or friends or whoever might be interested in getting involved in the brewery. And I think that's how a lot of us start. That's how we started. The one thing I will say about that, and it is great, I think you get the people that are in there for the long term are appropriate for that, but you really need to think about what could happen down the track. That's certainly something that happened to us, and it happens to a lot of people. Is what happens? You're all mates sitting around at the pub, and we're going to start a brewery, and we're going to be friends for life, and everything's going to be great. You really need to think about what is going to happen if a few years down the track, somebody needs to get out of the business, or you need to have really bulletproof procedures in place, and that's through shareholder agreements and things like that. So. Great way to get started, but just make sure that everybody who's getting involved knows that it's a long-term investment. They're probably not going to get any money back for a long time, if ever. All that kind of good stuff. It's the way it is.
Come on, it's not that bad.
You're in there for the love of it, as we all are. But also, what happens when somebody needs to exit the business? You need to make that as smooth and as easy, and how that might happen up front. As time goes on, and we all know that when we need more gear, when we need to grow, we need cash flow, we need more cash. A few years down the track might be an appropriate time to talk to a financial institution about getting traditional loans. You will hopefully have assets, you'll have a track record, all that kind of good stuff. So that becomes a more appropriate way not appropriate, but another way of funding that expansion. Now, obviously, the good part of that is you're not diluting the shareholding of your existing investors. So a good thing to think about with finance is your core group of investors stay the same, essentially, but you're bringing in loan into the balance sheet. The big thing to remember, though, is having the facility to pay that back. Now, these days, the bank or the financial institution will probably make sure that you have the facility, but you've got to remember that it's all great getting that cash into the business from a bank or a financial institution, but you also need to make sure you pay that back every month, on time, and it can be a bit of a drain on cash flow. So you need some pretty positive cash flow to be able to do that as well. So we've done all that a couple of times. We've also brought on investors throughout our life as well, so additional investors, and I guess against the bank loan. What that does is, yes, you bring more money into the business to buy more fermenters and get some cash flow, that sort of thing. But at the end of the day, you're also diluting the shareholding of your existing investors, including yourself. So that's, I guess, the bigger downfall. The big positive of that is that you're not, eventually you may have to, but certainly initially you probably don't have to pay those people back straight away. The third one is an interesting one that we embarked on last year, which is equity crowdfunding. That is a very complex way of doing things. I'll give you the reasons why we did it. A year ago, we'd been around for almost 8 years. We had generated a big following in the country. People knew us. People loved us. What equity crowdfunding allowed us to do was go to those people that had grown to love us, and not just throw us some money to help us grow again, But also, those people were very, very hungry and really wanted to get involved with our business. And what the big benefit we saw out of it was that we developed for us, it was about 530 brand ambassadors out there around the country, yelling from the rooftops how cool we are and how great we are and to buy our beer. And I think that's the big thing, the big advantage of equity crowdfunding. It's also a responsibility that you need to, make them feel loved. You need to make sure they're involved in the business. And that's a lot of time and a lot of effort. Probably something we underestimated, but it's important to us and we continue to do that. To keep in touch with them, get them into the brewery as often as possible, give them special things and make them feel part of the family because they're an investor in our business. So big responsibility. It's been very satisfying for us, but a lot of work as well. But essentially that is another cash injection into the business. It also comes with a whole lot of extra regulatory work as well. We have to publish our results, for instance. Some people do, some people don't. We will be doing that. Is Matt in the room? No, good, excellent. I'll be talking not long after the 31st of October, I'm sure. But there are, you are very, somewhere in between a private and a listed company, and there are a bunch of responsibilities that you need to make sure that you keep. And we've been doing that. And we've actually gone above and beyond that. We've gone back to our shareholders 6 months in, given them an update of how we're going. Not just, we've got some shiny new stuff that we bought with the money we got, but also our results and how things are going. And particularly important 6 months ago when, things weren't as rosy as we had have all hoped. Having an honest conversation with our investors to say, it's a tough environment, but glad we've got you all on board to help us as those brand ambassadors, like I said before. So they're kind of the three main ways that we've raised money over the years, and all kind of have their spot in the life cycle of a brewery.
Yeah, awesome. It sounds like the equity crowdfunding is a lot of work, and I guess in the current climate, maybe the metrics have changed a bit. Do you have any thoughts about that?
Yeah, I think for the same reason that the times are tough out there for beer at the moment, is that there's not a lot of spare money out there for people to spend on things like shares in a brewery. So I think that works. But yeah, there was a bit of around the time that we went into equity crowdfunding. There had been a few before us, but there certainly were a lot after us, and I think. The market got a bit saturated with a whole lot of crowdfunding in this industry over a short period of time. We saw some quite unsuccessful raises after ours. We were very happy with ours. We raised just over 1.7 million. So, but the reason we did that is because it was well into our life cycle where we had a strong following to invest.
Do you think that just in the climate as it is, that you would have to change kind of the percentage that you would have to give away for a similar amount of money at the moment? I guess that's I'm saying that because I kind of feel like that's kind of what's out there is that the funding that you can get at the moment from an equity perspective, you're going to probably have to give away a little bit more of your business for the percentage.
Yeah, it's a good question. Whether that's now or when we did it, we didn't necessarily our multiples, for instance, were quite low. We didn't want to, for want of a better term, take the piss too much. It was we wanted to have a fair value for our business. And breweries, it's hard. None of us make much money. So it's kind of, multiples of profit is not really going to get you very far. So trying to value what a brewery is a very difficult place to be. So some of the multiples we were seeing at the time, I think were a little too high. So we took ours back to a very reasonable level. We've luckily with the cash that we raised, we've now invested in more hospitality venues and we've seen our revenue rise quite well. So even in a tough environment, because we've got additional venues, we're able to show an increase in revenue over that time, which is great. So that multiple looks even better. I think are breweries sort of worth a little less than they were a year. If they hadn't changed, probably a little bit.
Yeah.
You know, it's a tough environment. I don't think there's any business or any industry in the world right now that doesn't have the same problem. I think we're all probably, our valuations will be a little bit less than they were a year ago.
Yeah.
But I just don't think there's the appetite in the market for it anyway. So
Yeah.
if you were going to do it, yes, you'd probably have to value it a little bit less.
Yeah.
Can I just ask a question, Dave?
Sure.
The investors that you had come on board, do they get involved in the business as well, like become directors or management, or do they just hands off?
Yeah, definitely not, and we're quite clear about that. It's they are investors in the business, they own shares in the business, but they're certainly not involved. Having said that, there are some particularly some of our, what we have tiers of membership, if you like, or we have what's called the inner circle, where those guys are members of, and there are different tiers. And some of the bigger investors do have some skills to offer us, and we have utilised that on a relatively ad hoc and informal basis. Certainly not directors or management in the business. So, and it's important, I think, with anything, whether it's people who get involved in the business at the very start, whether it's crowdfund, whether it's through whatever, it's very important to set that expectation up front. What we're expecting from you, which is just be ambassadors of our brand.
Awesome. Well, I guess we can open up to some questions if anyone has a question. I can't see anything through the lights, so. Over there, yep.
Do you go through multiple rounds of funding? Like, are you looking to kind of achieve one, like with a crowd equity, for example, are you looking to just kind of hit that once and go from there? Or is this a strategy that you use multiple times over the longer term?
Yeah, that's a really good question. And again, part of our, when we raised money a year ago, we definitely made it quite clear that this was the money that we needed to grow over the next 12 to 24 months. So it's certainly not the last time we will raise money. Is it the last time I think going further what we were saying before, I don't think I would do another equity crowdfund right now. So the next round of funding as we grow, again, our growth is not, I'm not going to sit here and tell you we're growing through going against the industry right now. We're not, a lot of our growth is in our additional businesses, but when it comes time to grow again, we'll definitely do something in one of those three options. And if that's in, say, 12 months' time and, interest rates haven't gone up too much and there's a little bit more money out there for people to spend, maybe we will do it again. I really enjoyed the exercise. It was a hell of a lot of work, but it really does make you look at your business, look at your balance sheet, look at your P&L and really focus. And even knowing that I've got to release my results to the public in a couple of months, which makes me nervous as hell, it makes you really focus on your business and making sure that looks okay.
Yeah, it's just awesome accounting practice as well.
Yeah.
Even if you're not looking.
I reckon I
to
could
sell
be an
your
accountant
business.
now.
Yeah.
Trust me, I don't want to be one.
Better at brewing accounts than most accountants, I would have thought. Any more questions? I can't. It's very hard. Oh, you've got the mic. There you go.
Dave, the question just in regards to the crowdfunding and that type of stuff as well, how do you manage dividend expectations and like you from the outset, or what have those expectations been?
Really good question. I think that's a question across both, whether it's equity crowdfunding or private investment. Essentially, is that you need to set an expectation. We set the question was asked around the time that we were crowdfunding, and also when people come on as private investors. If you're in this to earn huge dividends in the year after that the crowdfund comes into place, then that's probably not the right investment. It is a long-term investment. I think that what isn't. Any share on the stock market would say the same thing. You need to have a fairly long outlook because you never know what's going to happen. But we would hope to. We are obviously our aim is to get some fairly decent returns over the next few years, and hopefully we can share that with our investors. But there certainly isn't anything. There certainly are no promises made that you will get X dividend. Like any company, I guess you just don't know what's going to happen. Does that answer your question? Yep.
I'm interested in your thoughts on this. Generally, you find breweries start off with the family and friends contributing. There might be a shareholders agreement, there might not be. Generally, if there's then a sort of second round of funding, you put that in place to govern the relationship and set expectations of things like dividend, if you get to that stage, which is great. But then when you go down the equity crowdsource funding, you generally have to get rid of the shareholder agreement and just have a constitution that governs all of that sort of stuff, and you tag along and drag along in case there's an exit event. How did you go through that process of having to get rid of the shareholder agreement from before and go to a constitution, and how did you find that experience?
Getting all the questions here. Sorry, guys. Interesting question. It's a good question. Let me go to the first part. I would never, if I could go back to the very beginning, even if it's even just family or just you and your partner, I would still have a shareholders agreement. So the constitution and shareholder agreements are two different documents, and they're both necessary. Shareholder agreement goes in a bit more detail about the sort of things that you're talking about in terms of what happens in certain situations. And I think always have those in place. If you don't have them in place, get them in place. Because it's just it's really just making sure that everybody knows and agrees what happens in certain situations, and you never know what's going to happen. It doesn't have to be difficult situations. It might just be somebody's family situation means they need to get out of the business, and it's just the way life is. So what happens in that regard? So I always have that in place from the beginning. From an equity crowdfunding perspective, we don't get rid of the shareholders agreements. It's just as important, if not more important. Our shareholders agreement was pretty covered most of the things we needed to with those additional shareholders, and essentially they become what they call parties to the shareholders agreement. So we certainly didn't get rid of it. As far as I know, you would still need one in place. If I could do it again, I'd probably make a few little adjustments. I think the main thing is it's tough for it's not like a public company where you can just trade shares on the stock exchange, and it is difficult to sell shares and trade shares in the company. I'd like to make that easier, and we're currently working through it at the moment. How can we make it easier for somebody who wants to sell their shares to do that? Because a lot of shareholders agreements and constitutions are set up that you need to involve all the shareholders in any type of share trade, and in a crowdfunding environment that's a very difficult situation. So that's probably the one thing I'd recommend to look at pretty early.
Yeah, you find that everything that you say, that'll never happen.
Yeah,
it always happens.
Yeah, it's very, really important. It's one thing I recommend to everybody.
Absolutely.
Hi.
Hi.
Question for Liz. With Shift, you guys are looking like you're getting into invoice financing. I know with Shift that a lot of your loans for businesses, drawdown sort of thing, are more like credit card rates, 20 to 30%. What sort of pricing do you charge for your invoice finance?
Yeah, so with the invoicing finance, or our trade platform is what we refer to it as, the fee that we charge to a supplier is going to vary on the term. So if you want to offer your customers 14-day trade terms, you're going to be looking at around that 0.69% per transaction. And then obviously the longer the trade term, the more you're going to pay in a fee. And that's an upfront fee that you pay per invoice.
I don't really have a question, but I feel it would be a bit remiss of me not to introduce myself, given the topic of the discussion. My name's Mark Hubbard. I was the founder of Blizzard Brewing Company up in the high country of Victoria. I sold the company during the pandemic and retired, missed the industry, and got back into the industry. I'm working with On Market now, which is a financial intermediary doing crowdsource funding. And I'd love to answer any of the questions that you have that you can direct to the panel, or I can go into more detail with you and give you some more information on that. I would have loved to have been on the panel myself, but I was busy getting a new knee put in, so I didn't even know if I was going to be able to get here till last week. Thank you.
Thanks. Any more there? I'm sure that everyone here would love to talk to you. So Liz and Damien both have stands in the expo, and are you around today, Dave?
I will be running around today.
Excellent. So I guess thanks everyone for coming in, and yeah. Oh, one more. Here we go.
I'll just add to that voice, Russell Steele from Easy Times Brewing Co. Just given the topic, I want to flag to the room, so many of you will be aware, we went through voluntary administration in the last 12 months. Times are tough out there. If you are struggling, get early advice. The only reason our doors are open today are we went early. Bills were building up. They were building up. It was getting hard. Get good early advice if you are facing that cash flow problem that we're all facing. The earlier you get that advice, the only chance you get to keep your doors open in a lot of cases. There's going to be more. We all know that. And if you want to ask questions about the experience we have, come and find me anytime.
That's really excellent advice. And I guess, if that's it, then thanks everyone for coming along, and thank you so much to the panel for joining me today. And look forward to seeing you throughout the rest of the conference, and hopefully the Indies tonight.